The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The market's on edge with oil on tilt, the Fed in the freeze as it flies blind amid the fog of war. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick, counting you down to the closing bell with U.S. equity indices near session lows, oil near session highs, and the sell-off in short-term treasuries resuming after a three-day reprieve. U.S. policymakers keeping the benchmark federal funds rate exactly where it's been since December, and plotting out the likelihood it will make good on that one rate cut for 2026 that it had earlier telegraphed. An updated summary of economic projections. It did show an increase in inflation expectations, but also an increase in the GDP outlook. But Jay Powell says for now, take those projections with a grain of salt.
The thing I really want to emphasize is that nobody knows. You know, the economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that you know, to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through.
One of the more revealing comments from Jay Powell's press conference was just wrapped up a little while ago, coming off of that 2 p.m. announcement here, keeping rates exactly where they are. But some big questions now about where we go next. Ken Shinoda kicks us off to the close, portfolio manager over at Doubleline Capital. And Ken, I really thought that comment kind of encapsulated the bind that the Fed is in right now. They obviously are looking at a labor market that, in their view, at least if you read in between the lines, probably a tad weaker than what it was, but also looking at an inflation picture that is now, let's just call it, completely uncertain.
Poor Powell, he was in a good spot. He thought he would ride out into the sunset, inflation coming down, and then oil spikes $30. And yeah, the labor market was weakening, and they thought they would be able to cut, but with the spike in energy prices, it just doesn't seem like they could cut this year. The probability to cut last night was one cut at the end of the year, and that's dropped below one cut. So it seems like unless we get a resolution in the Middle East, that the Fed's going to be on hold throughout the year.
And it gets to this idea, and Powell seemed to be very cautious about, certainly did not use the word transitory, seemed to dance around even the idea that the Fed was discussing that. But it seemed like for a while the market, Ken, was kind of viewing this energy shock, if you will, if we want to call it that, as transitory. And the idea that they seem to be positioning, if not necessarily an end to the conflict, the idea that this rise that we've seen in energy prices would not have a lasting impact on economic activity. How do you view it?
Yeah, I mean, I think a couple of weeks ago when the conflict first started, definitely the market was trying to look through it, but it seems like this is going to last much longer than anticipated. Equities are pretty volatile here, but surprisingly not down that much. I actually would think they'd be down given the pass through of energy prices into gasoline, how that leads to consumption and spending. So I think markets have been surprisingly resilient. If this keeps going, I would expect more volatility.
Yeah, and to Powell's point, too, he sort of referenced this idea that all the talk of stagflation is probably a little bit overblown, basically saying that this is not the 1970s. In his words, that was a much more serious set of circumstances. I guess my question, though, and particularly for you, as someone who is very active in the rate space here, when you start to see yields go back up, and I think right now, certainly on the 2-year yield, we're at the highest level since the war began. What is that telling you right now about the psychology of where traders think this market is going to go?
Yeah, well, the front end is pricing in the lack of cuts. The front end is saying with inflation here, there's just no way that they could drop rates unless energy prices come down meaningfully. And then the longer end, we're kind of in the middle of the trading range. The 10-year got down below 4% over the last couple of years. We've kind of seen 380 a couple times. We're at 420 right now. We've seen 450, so we're kind of in the middle of that trading range. It's hard to get overtly bullish on the long end. I think kind of that 2 to 5 year portion, now that it's repriced, looks interesting. It's hard to see the 2-year rise meaningfully unless we think inflation is going to stay high for many, many years. And for now, at least, if you look at break-even inflation rates, longer-term inflation expectations, call it 5-year inflation expectations, are still sub 3%. So it's kind of hard for the 2-year to break too much higher I think you'll see more buying there than potentially the long end of the curve.
I thought it was interesting, the relative lack of dissent, particularly given some of the drama that we saw in the previous meetings. But I do want to address the elephant in the room because, and with regards to Powell's tenure, because it seemed like part of the case for rate cuts, at least in the minds of the market, wasn't just the economic data itself, but also the idea that you were going to get Kevin Warsh to lead this Fed, and that, in theory, was going to push the Fed in a much more dovish direction. Does the idea, as Powell addressed today, that, well, he might have to delay his vacation plans for a little bit, does that change the calculus for how you think the Fed might actually tilt one way or the other?
Warsh comes in. I know he talks dovish, but he's got to fight the mandates of the Fed. He's got to fight inflation. He's got to keep employment strong. And if inflation's high, I just don't see how he could cut the 100 basis points some people are calling for. Just earlier this morning, you have some market participants saying, yeah, buy stocks because the Fed's going to cut. I mean, the market's not pricing that in, so I don't know where they're getting that information, but they're going to have to do what the data tells them to do. They're going to be very data dependent. And I think you just have to watch that data. And if the energy prices stay high, it's very hard to cut rates. I do want to get your thoughts on something non-Fed related. And this really has to do with what's been going on, Ken, in the world of artificial intelligence. And, of course, the CapEx spend and now the big borrowing that we've seen in that space to fund that. We've already heard from some other fund managers out there saying that, at least for right now, particularly when it comes to software, they're not really willing to wade into that space right now. Are you comfortable with what you've been seeing with regards to the borrowing overlaid with the idea of what may or may not actually be the return with regards to some of those AI investments? Yeah, we're in the very early innings of AI CapEx spending, borrowing in the debt markets, and become a larger and larger percentage of many markets. Right now, it's very small. There's a couple kind of off-balance sheet IG transactions that have gotten executed out there. There's some transactions being done in bank loans and private credit. CMBS market is lending to some data center owners. The ABS market's funding some data center infrastructure. But with time, it's only going to grow. I mean, if the market participants are right, and we're going to see multiple trillions of dollars of CapEx spending, it's going to become a meaningful part of the debt markets. And in debt markets, you don't have infinite upside like stocks. Like if you're going to own AI, I joke, you might as well own the equities. Right now, the spread pickup for some of these transactions is minimal with a lot of uncertainty. So what we're doing at Doubleline is we're avoiding as much of this exposure as we can until we get paid more for it. If we see a correction, maybe we'll wade into the waters. But for now, we think it's prudent to kind of limit our exposure in that market.
All right, Ken, have to leave it there. Always a pleasure. Ken Shinoda, portfolio manager over at Doubleline Capital, counting us down to the closing bells with stocks right now at session lows, oil near session highs, and some big earnings after the bell out of Micron.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here to take you through the closing bell. Katie Greifeld is on assignment, but Carol Masser and Tim Stenovic join us as always. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. A very busy afternoon here as we await some earnings out of Micron. And of course, now, just about an hour or so removed from a big Fed decision that actually didn't move rates, but actually said a lot about where the Fed is at.
Yeah, kind of fascinating. And I think the big headline is Fed Chair Jay Powell basically, I'm not going anywhere. We're going to wait until all this stuff is resolved. We just talked with Greg Peters over at PGIM, and some of that saying, here is a Fed chair that is willing to stay put, not cut rates, do the right thing based on what the economy needs. And so that kind of helps explain what we are seeing in terms of market reaction. Stocks under pressure. And he talked about the yield curve in terms of a flattening, but we did see certainly yields move up.
Yeah, and not to sort of belabor the point about what we learned from the plans for Jay Powell, because I do think that was a big bit of news that we got, Romaine.
Yeah.
I guess the ball kind of moves into the court of Jeanine Pirro, U.S. Attorney for Washington, D.C., Senator Tom Tillis with the nomination process and whether or not, we could see a Fed chair nominating process in the next few months. Because if we don't, then Jay Powell, he's there.
And it's messy. And I'm just going to borrow a phrase that John Farrell used on the Fed special here. The idea of this type of a messy succession plan, if you will, for the most important financial institution in the world, no bueno. No bueno here for the equity markets as well. We started the day in the red, but they were modest losses to start. Those losses accelerated once Jay Powell started speaking, and they accelerated even further when we got closer to the closing bells. The broadest base sell-off that we've seen in the S&P 500 all year long. Down 91 points on the day, or 1.4%. The Dow Jones Industrial Average losing 770 points, or 1.6%. The NASDAQ Composite down about 1.5%, and the Russell 2000 giving up about 41 points, or 1.6%.
All right, back to the S&P 500. No surprise as we see stocks selling off here following the Fed decision. Romaine, we've got most names in the S&P lower today. 422 to the downside, 81 actually gaining ground on this Fed Wednesday. So, yeah, a lot of selling here.
And all 11 sectors in the S&P 500 are in the red. Consumer staples and discretionary stocks, the biggest decliners there. But honestly, nothing was spared. And that even includes energy. That was actually fractionally lower on the day. We should point out that as we speak right now, we are seeing the Brent crude prices climb back to those intraday highs around $109 a barrel, and yields right now on your 2-year, the highest that they've been since August.
All right, everybody, we've got Micron crossing the Bloomberg terminal, so let's go to it as they cross. Bringing up my headlines here on the Bloomberg. Second quarter adjusted revenue. Folks, pretty big beat there. $23.86 billion. Wow. Street estimate was $19.74 billion. Check out the second quarter adjusted gross margin. Investors were expecting a lot, and they're getting it. 74.9% on that adjusted gross margin. Estimate was 69.1%. Second quarter cash flow from operations, $11.9 billion. That compares with an estimate of $8.93 billion.
I'm sorry, can I just stop you there? Because I know you're comparing it to the estimates. But I just want to compare that year over year. $11.9 billion in cash flow from operations. Mm-hmm. A year ago, that was $3.94 billion. And similar story in revenue, $24 billion in revenue. A year ago, that was $8 billion, Carol.
Well, get ready to pop your eyes even more, because third quarter adjusted revenue, here's the outlook. Revenue of $32.75 billion, folks, to $34.25 billion. Street estimate was $23.66 billion. Stock up about 2% here, Tim.
Look, Sanjay Mehrotra, president and CEO of the company, says this is economics 101. It is all about supply and demand, Romaine. He said Micron set new records across revenue, gross margin, EPS, and free cash flow, driven by a strong demand environment, tight industry supply, and our strong execution. In the AI era, memory has become a strategic asset for our customers, and we are investing in our global manufacturing footprint to support their growing demand.
I don't know if you read the revenue, the projections yet, Carol, so forgive me if I repeat this here, but the third quarter adjusted revenue numbers, that 32.75 to 34.25, and that's above estimates. But you mentioned the stock move here. I just want to put this into perspective. You have a more than doubling in revenue in the most recent quarter, guidance that's going to even grow, 50, 60 plus percent more for the next quarter, and the stock is only up 0.9%.
Yeah, it is kind of bouncing around here. So what are they looking for, right? I think one of the things that that investors, analysts wanted to know, it had to do with pricing and whether or not what we're seeing and whether that continues. And this certainly plays into margins. That's probably why their margins are kind of off the chart. But we've got to get a little bit more clarity on that because that is certainly something that investors want to know.
All this, I guess what I'm getting at was all this pricing. I mean, this is a stock that was up, coming in today, like 390% over the last 12 months. I think 65% just to start the year alone. And the question is sort of what's the bar? We saw this similar with NVIDIA when it started, giving those forecasts the other day, and investors are kind of like, okay, $1 trillion in revenue, that's nice, but what else you got?
Yeah, and look, I think to your point, I mean, given that NVIDIA is 17% of Micron's revenue, according to the supply chain function on the Bloomberg terminal, then maybe some of this was priced in because you get visibility through other companies and what other companies are selling.
Absolutely. And we talk about this idea of just this shift now away from the building of these large language models to this inference phase that Jensen Huang talked a lot about. And of course, it's these memory chips, particularly these dynamic random access memory chips that Micron specializes in, and it could be a big beneficiary of that. But also, I'm curious to see what they have to say on the call, because remember, last quarter, the issue they had was the demand's there, but they don't have the capacity to actually build this stuff yet. And there's a lot of questions as to how you meet that demand and whether they can do it in a fast enough time.
They said they're investing in our global manufacturing footprint to support their growth demand, reflecting confidence in the sustained growth of our business. This is another headline that's crossing. Our board has approved a 30% increase in our quarterly dividend. But I think a lot of analysts to your point, Romaine, on the call will be asking, okay, how long does that manufacturing, global manufacturing expansion, how long does that take? How long until you can actually build enough to get demand or to satisfy the demand? But then also, where will we be in the cycle at that point? That's the challenging part.
Well, that's a good question. I think BI was that thing that they're apparently trying to build out there in New York State. The idea is that maybe 2028 would be that. And we're talking about a business that historically has been highly cyclical. And I know we're kind of not in a cyclical phase now. It's more of a structural phase. But to your point, what is the market going to be like in late 2027, 2028, if they do start to bring additional manufacturing on?
All right, I just want to go to Dina Bass, actually posting a story on the Bloomberg. So she says, Micron offering a positive forecast for the current quarter after surging prices for computer memory chips bolstered its prospects. She got to that fiscal third quarter revenue being approximately $33.5 billion. Profit will be $19.15 a share, compared with analyst projections of $23.7 billion in terms of revenue for the third quarter and $11.29 a share for profit for the third quarter. But again, she goes to memory prices. She says they're soaring because of shortages fueled by AI computing demand, and the global shortage is likely to persist another 4 to 5 years due to constraints in semiconductor production. Folks, this is basically supply and demand. When there's not enough supply out there and there's a lot of demand persisting there, prices go up, margins go up. It makes these companies much more profitable.
At some point, though, doesn't that begin to work against them, Carol? Isn't that kind of the problem? Is at some point people are going to be like, we can't afford this. And let's face it, I mean, to kind of circle this back to the Fed as well, and of course what's been going on in the Middle East, there's been a lot of discussions about how we could actually see more upward pressure on prices because of the disruption of a lot of the key chemicals and supplies you need to make this stuff.
I think you bring up a good point about potential disruptions, but if we play this through and talk about, again, NVIDIA being its biggest customer, NVIDIA has a lot of pricing power right now because there really is nobody else that can produce a lot of what NVIDIA produces and sells. So as long as NVIDIA continues to have that moat and can control prices and say, okay, well, this is what, look at NVIDIA's margins. Until those take a hit, then maybe Micron can keep increasing prices because NVIDIA passes those along because NVIDIA passes those along to customers.
I mean, their biggest customers, NVIDIA, Lenovo, Microsoft, Dell, Apple, Amazon. I'm guessing these guys have the money to do it. Like, they keep tapping, we know, the debt markets and so on and so forth. I have not seen any of them say we can't afford to actually spend on this. I don't disagree with you, Romaine. At some point, you do wonder, when does this start to slow down? But at this point, everybody seems to indicate that the demand is still there.
Yeah, look, I mean, the money's there. The question is, when does it stop being a wise use of the money? I'm really curious to see what they say on the conference call, which is what I think it's going to be at 5:30 p.m. East Coast time today, and whether they can kind of articulate a little bit more about the build out, potential manufacturing build out, but also how long they think this cycle could potentially be.
And on that, Dina Bass just saying in the AI market, Micron is working to ramp up production of new high bandwidth memory, or HBM4. And she says and writes and reports, a big question is how much NVIDIA will rely on Micron for that component. And that's where it kind of also gets a little tricky. All right, guys, we're going to continue certainly watching this one in the app.
Did you change studios?
Well, I was going to say, Romaine, maybe you and I should go into memory selling.
I'm so glad you noticed so quickly.
Because there's so much demand.
We should. I'm still.
Nothing gets past you, Romaine.
Going through my storage unit, finding laptops from 20 years ago.
Micron's down about 1% now, guys, in the aftermarket.
Like a scrap dealer.
Down. Yeah. Talk about moving up and down here. All right, guys, that's a wrap. Nice to kind of just chat with you, Romaine.
It was nice.
I mean, I love all your.
You were smart today.
All right, that is a wrap. Across platform, radio, TV, YouTube, and Bloomberg Originals. Romaine, just there solo over on the TV side, continuing, of course, on The Close. And Tim and I continuing on Bloomberg Business Week Daily right here on radio. Folks, we will see you again, same time, same place tomorrow.
Another blockbuster quarter for Micron, though the share is under pressure here in the after-hours trade. We're going to talk about this structural cycle that we're in right now when it comes to chips and memory chips specifically. Matt Bryson over at Wedbush. He joins us in just a second, right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostic. We take a look at how U.S. equity markets closed out the day, and it was a down day. Accelerated selling into those closing bells, down about 1.4% on the S&P 500 for the broadest based sell-off that we've seen for the benchmark index all year long. That, of course, was tied to a lot of concerns about the uptick in inflation amid the war in Iran and a Federal Reserve that, at least for right now, seems a little bit paralyzed with what to do next. Your two-year yield, that is, of course, the yield that is most sensitive to Fed changes, that is up 9 basis points and now at its highest levels going back to the summer of last year. Brent crude prices that are in the new session, they're actually trading above where they were in the previous session, $110 a barrel. Spot gold down about 3.4% here on the day. As for the individual movers, you got no help today from the big tech stocks. Microsoft was down, as was most of the Mag 7. You did have a few bright spots there, including Cloudflare on the back of some reporting here about a potential stable coin. And you had a newcomer to the market, Swarmer, that is the AI drone company, which rallied 500% on Tuesday, up another 77% today. And SanDisk during the regular session was up about 5% on the day. But SanDisk, of course, now under pressure here in the after hours trade on the back of those earnings out of Micron. And that does bring us to our top story to kick off the hour. It is a focus on the economy, but the main pillar that has kept it and the stock market afloat, the unrelenting spending on AI. One of the biggest beneficiaries has been Micron, the biggest U.S.-based maker of memory chips. It's been riding high. Revenue in its most recent quarter, the fiscal second quarter, came in at $24 billion. That's 3 times what it was a year ago and almost 4 to 5 times what it was a couple of years prior. Quarterly net income surpassing $14 billion. That's almost 8 times what it was just 4 quarters ago. Micron stock, the best performer in the Philadelphia Semiconductor Index over the past 12 months, and third best performer in the NASDAQ 100, almost quintupling in price over that time. But of course, those high numbers bring high expectations and a lot of questions now about where we are in this memory chip cycle, how long it can go, and just how much Micron will benefit. Matt Bryson joins us right now, Managing Director of Equity Research at Wedbush Securities. And Matt, I mean, look, let's just start off. This was a phenomenal quarter, a blockbuster quarter in terms of the aggregate numbers, in terms of the growth, in terms of the margins. I don't think there's a number in here that you can really quibble with. However, I am curious as to where we are in this super cycle, or whatever we want to call it right now, and whether investors should still be riding it or maybe be a little bit more cautious.
Yeah, Romain. So I think we still have some room to go. Memory is very much a supply-driven business. So it's not how much demand there's out there. It's can the vendors bring on enough supply to meet that demand? And because you have these long lead times for fabs, we don't really begin to see new supply coming on until next year. And it may even be 28 before Samsung, Micron, Hynix can catch up with all the demand from AI.
But is there a sense here, though, that there's any sort of negative to this? And by that, I mean, the idea is that if the demand's there, will it be there? We were talking a little bit earlier on the program, the idea that once you start to get manufacturing capacity up and running, will that cycle still be there to support that expanded capacity?
Yeah, at least from what I'm seeing, companies have already set their purchase orders for things like HBM for 2027. So I think if those large customers are certain enough that their demand is there to place orders, then Micron and the memory makers don't have a demand problem yet.
We are getting additional headlines now. They are addressing some of these issues right now, talking about that they still see a tight DRAM as well as a NAND market beyond 2026. I think they've kind of said that before. It gets to the question, too, Matt, that where are we right now with regards to just the AI build out? And I bring that up in the context of what we heard from Jensen Huang earlier, who talked a lot about how we're kind of shifting now to this inference phase, which, of course, brings a whole different set of power demands and chip style demands as well as memory demands as well.
Yeah, so Jensen told you he's got $1 trillion in business between Blackwell and Rubin. And by my math, that shows some slowing in 27, but you're still looking at something like 40% annualized growth off of really, really big numbers. And so if you believe him, and he's got better visibility probably than anyone else out there, then there's still a fair amount of growth left with AI.
All right, Matt, really appreciate you giving us your snap opinion here as we await that conference call in just about an hour or so's time. Matt Bryson, Managing Director of Equity Research over at Wedbush Securities, a blowout quarter for Micron Technology and guidance for the current fiscal quarter of revenue of roughly about $33.5 billion. When we come back, we are going to turn back to the Fed, and we're going to turn to Jay Powell and his future. Apparently, he might be staying put for a while. Former Vice Chair Lael Brainard joins us in just a second to talk about what comes next. This is The Close on Bloomberg.
I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you will all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve.
Fed Chair Jay Powell addressing, well, I guess the succession planning going on right now at the FOMC and the Federal Reserve Board, particularly given what is still an open investigation by the DOJ. Joining us right now is Lael Brainard, former Fed Vice Chair and former Director of the National Economic Council. And Lael, before we get to the actual Fed decision and some of the economic projections, I do just want to ask you about kind of what actually transpires over these next few months with the possibility that we could actually see a sort of a chair pro tem situation with Jay Powell. We could see him stay on as governor, particularly as this DOJ subpoena case, whatever we want to call it, remains unresolved and could actually hold up Kevin Warsh's confirmation.
So clearly he wanted to put that statement out there today to be very clear that his leaving the board would be contingent on that criminal investigation being terminated. And of course, that lines up with Senator Thom Tillis, who has said that he will not move forward on the vote for incoming nominee Kevin Warsh until that criminal inquiry is dropped. And the administration has a very clear path to do so. The statement on the part of the district court judge, very clear. They did not see a case here. And so by simply not moving forward with an appeal, it would clear that path, at least to get Kevin Warsh a vote and to get him onto the board. What happens after that, Jay Powell wouldn't say.
He would not say. He also wouldn't say a whole lot about the inflation situation. He was asked. He answered it, I think, the best that he could. But he also seemed to make clear that right now, no one really seems to know anything. I thought his comment about the summary of economic projections, which was basically, hey, we had to write something, so we wrote it down. But that didn't sound like there was a whole lot of conviction that forecast, whether it's on the GDP side or the inflation side, is something the market should put a whole lot of stock in. How did you view it?
Yeah, I found it surprising. We did not learn really anything about how the committee is thinking about the effects on inflation and the economy from the oil price shock, neither in the statement nor in the summary of economic projections. Yes, they marked up core inflation a few tenths, but that could simply be reflecting the reality that core PCE has actually moved up a bit in the last few months and is expected to be a bit stickier than before. But what was interesting is that he wouldn't use the word transitory, but essentially they look like they are treating the oil price shock as transitory.
Well, yeah, and he was very careful not to use the T word. But I am curious about this idea of just the compounding effects of everything, because I think one reason why I think the market talks about it being transitory, because we've kind of been here before, whether it was obviously the supply chain issues with regards to COVID, and then obviously whatever happened with the start of the Russia-Ukraine war here. Is there a reason not to view this as potentially transitory?
Well, I think that we have to at least consider two reasons this time may, in fact, be different. One is that the size of this oil shock is unprecedented. The Straits of Hormuz have not been closed before. 20% of oil production. That is very material. and nobody knows how long this is going to go on. The second reason that I think we have to be a little bit cautious before we dismiss this as transitory is this oil price shock comes on the heel of a series of supply shocks, very significant tariff shock to the supply of labor, and of course, coming off even earlier, a period of high inflation. In the kind of circumstance where you have a series of supply shocks that individually might be actually transitory, you do have to worry, and I did back when Russia invaded Ukraine, you have to worry about the cumulative effect on inflation being somewhat more persistent.
With regards to that balance of monetary policy or the balance between the dual mandate, there's been a lot of talk about how the labor market is in a different place than where it was in 2022. And obviously, the circumstances around COVID were entirely different. How do you view the labor market right now, particularly through the lens of the potential for a more meaningful move up in inflation?
Well, it's certainly the case that in 2022, the labor market was strengthening. And now, of course, we've seen it barely treading water over the last year. And it's hard to read, as the chair said, because we've seen a reduction in the supply of labor at the same time. So they are putting a lot of store on that unemployment rate just remaining very steady, even though we've seen payrolls growth be essentially zero for the last little while. So I think there is a risk to both sides of the dual mandate from this oil price shock, both more unemployment and more inflation. And that is why this could be quite a difficult balancing act for the Fed in the months ahead. But the other piece that I think is an important contrast to 2022, in 2022, inflation was just starting to really spike up after a long period of being very quiescent. Now we are seeing an additional shock to inflation after 5 years in which inflation has been quite high relative to its target.
Well, this also gets to this idea, though, too. I mean, we've heard from a couple of consumer product companies over the last couple of weeks that have made it clear that a prolonged increase in oil prices and effectively for consumers, that means higher gas prices, is going to have a material effect, particularly on discretionary buying, but even on buying of essentials. If that does potentially end up being the case, how confident can you even be in some of those GDP projection numbers?
Well, I do think that consumers are stressed by high prices. I've done a bunch of roundtables with consumers who essentially point to food prices going up, electricity prices going up, housing prices not seeing any relief, and now, of course, gas prices for the first time in over a year are going up. So I do think consumers were already feeling stressed, and we could, in fact, see some consumption pullback. Now, on the other side of that, people are getting their checks, their tax refunds, and so that might help insulate if this is not a prolonged shock.
All right. Well, on an inflation-adjusted basis, those checks just got a little bit smaller. Lael, appreciate your candor there. Lael Brainard, former vice chair of the Federal Reserve. We should point out gas prices up about 30% at the pump since the war began. And I do want to draw your attention to the oil markets. Post-settlement trade right now has Brent crude back at $111 a barrel. WTI crude right now flirting with 99 and change. When we come back, we're going to talk about the investor. We're going to see how they're feeling. The CEO of Edward Jones, Penny Pennington, she's going to be joining us in just a second, right here on The Close, right here on Bloomberg.
People write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down.
And Jay Powell there getting a chuckle out of the journalist there as he talked about that summary of economic projections and kind of making it clear, don't put too much stock in it because there really is just a lot of unknowns out there. Here to talk a little bit more about what she knows, what investors know, and more importantly, how they're feeling is Edward Jones, CEO, Penny Pennington, who joins us here live in Studio 2. Penny, great to see you again.
Romaine, good to see you.
I know we talk, I mean, look, the economy is always, to a certain extent, a little bit of a fog. I mean, we're always just trying to guess kind of where things are going, but it feels a little bit different right now, given the overhang of the war, the spike that we're seeing in energy prices. I am curious as to sort of how you approach these types of moments, which aren't, I won't say they're not common, but they're not necessarily rare either. We've been here before where we've had this type of fog here. How do you either look through that fog or grope your way around it to sort of figure out maybe what people should actually be doing and where they should be putting their money?
Yeah. Well, it's great to be with you and your audience. And the reason that we come and share, Romaine, with you is what we're hearing from 9 million clients that we talk with every day. And you know, you said being light with the reporters there, Chair Powell. None of it's any laughing matter. And at the same time, your insight is correct. We have been here before. We've had times of anxiety, of economic uncertainty, of war, of times that make people very, very anxious. However, Chair Powell said it, we got to be humble right now, right, about what we know and what we don't know. But the Fed also raised their expectations for productivity in the U.S. economy. They're not calling for a recession, nor are we. We don't think that that's the case. The fundamentals of the economy are strong right now, notwithstanding, and we should have tremendous respect for what's going on in our world right now and be very thoughtful about the people who are in that conflict. But that notwithstanding, prices have begun to moderate. Inflation has been coming down, albeit slowly. Interest rates are coming down a bit. So the productivity in the economy and the productivity that we may gain, and we believe this is the case from AI and generative AI, we think that's a real thing. It hasn't all come through yet.
Well, that's what I'm curious about, because prior to this war starting, there were a lot of positive signs in the economy, as you mentioned. I mean, we had mortgage rates coming down. You actually saw a pretty healthy uptick in selling and buying activity in the housing market for the first time in a couple of years. And it raises the question as to what we're seeing right now with this impact of energy prices. Does that become just kind of a temporary speed bump in all that, and the structural issues that were in place in January, February, that at some point, those will dominate the conversation once again?
The way that sounds when we talk to our clients is, Penny, if I were the financial advisor, and I once was, Penny, I know what's going on in the world. How does that affect my world? And so the conversation that we have with our clients is, tell us about your goals. Let's revisit your goals for the long term. Let's revisit how you feel during a time that can feel a little anxious. Has it shifted your risk tolerance? Let's take a look at your portfolio. Does it continue to be well balanced against the goals, your long-term goals? And then as we look at how the effects of price changes, whether they be temporary or long-term, on the decisions that a client and a client family might make about not just their investments, but how they choose to balance their saving and investing between different kinds of goals, be it long-term goals for long-term care or retirement or education goals, or in this case, what many are facing today is legacy planning. We're in the middle of an intergenerational wealth transfer right now across 4 generations, where families are moving their wealth and their values to the next 2 generations. And so the conversations associated with that and how the current impacts affect those near and longer term decisions is what a great financial advisor is talking to clients about right now.
And, as we sort of, start to go through this major wealth transfer, we're also going through a major sort of transformation of financial markets. Obviously, private assets have become much more talked about. They're not just for institutions anymore. To a certain extent, they're becoming much more available to individual investors. And even aside from just private assets overall, you've seen a lot of individual investors start to look for assets other than just, stocks and bonds, whether it's digital assets, et cetera. How do you factor that in?
Well, what they're focusing on is diversification, and diversification has been a sturdy, durable rule of the road for investing for the last 100 years. We think good diversification and high-quality assets are the fundamentals for a strong portfolio. Private assets may be, under certain circumstances, a correct investment for clients to be making. It depends on the level of diversification they need. It also depends on their risk tolerance and their need for liquidity. And a lot has been written about this just in the past few weeks. Private investments are structured differently than those in the public markets. And it is also true that I think I saw the statistic, 85% of companies with $250 million of revenues or more are private companies. And so more clients want access to those early stage companies, want access to those opportunities for growth and innovation.
But when we talk about early stage companies, I mean, we have to kind of separate kind of what we're talking about here, because I think a lot of the headlines have been more, some of the more mature companies, some of the ones that were, have been kind of under the wing of private equity and private credit. Is that what you're talking about, or are you talking more companies more at the kind of VC stage?
Really the entire range of private assets, but what you're getting at is so important. It is helping clients understand what sort of asset they should have in their portfolio and what kind of ride it's going to be for them when it's there. We believe that private assets should be a smaller position in a portfolio and are meant for people with generally more complex needs, longer time horizons, a greater need for diversification, but building the right expectation for liquidity, for risk, for all of those aspects of that investment are very important in the advisor-client relationship.
And are you making sure that your advisors are educated up enough on that to be able to educate their clients?
Absolutely. As we have been about emerging investments for decades. We've been around for 104 years through thick and thin with our clients. And so helping them make sense of those investments and making sense of the right place they should have in their portfolio is our job.
Penny, always a pleasure talking to you.
It's a pleasure, Romaine. Thank you.
Penny Pennington, she is the CEO over at Edward Jones. Before we go to break, we do want to check in here on the after hours trade. We are awaiting that conference call from Micron in just about 52 minutes here. The share has been under pressure after a blockbuster quarter. Of course, a stock that had quintupled in value over the last 12 months, down about 1.6% in the after hours trade and dragging down some of its peers, including SanDisk. We'll be back in a moment. This is Bloomberg. The Securities and Exchange Commission here in the U.S. out with new guidance this week for which digital assets it considers to be securities. It's a key step on the long-fought road to crypto clarity, with the CFTC throwing its support behind the interpretation. Joining us now to discuss is the director of the Division of Corporation Finance at the SEC, Jim Moloney. Jim, thanks for being here. All right, let's get to exactly sort of what the structure is here. Basically, we're talking about things like stable coins, collectibles, digital commodities, et cetera. These will not be securities. However, things that are tokenized, for example, those end up being securities. Is that kind of the gist of it?
Well, Romaine, thanks for having me. I appreciate it. Glad to be here. Yes, the interpretive release that came out yesterday basically is an interpretive release from the commissioners at the SEC. And what it does is it breaks down into baskets the different types of instruments there can be. Correct. There can be commodities, there can be currencies, there can be securities, there can be collectibles, and then you get into the details of stable coins and tokens. And so I don't want to be too detailed about it, but the interpretive release lays the framework for exactly helping folks identify which category they're in.
Well, when we talk about this, the framework here, I mean, when do we get to the stage of formal rulemaking and the idea that this actually does become enshrined in regulation?
Sure thing. Well, I started probably about 6 months ago, and we've been actively working on the rulemaking. There is a proposing release in the works, and as you know, we have the Clarity Act that's floating around on the Hill, and there's a lot of folks working on legislation. So our rulemaking is basically setting forth a framework that will perform the foundation for the legislation when it comes. So the SEC won't have the answer to everything, but we are establishing in a proposing release how we would envision these instruments being regulated.
So this interpretive release that you put out here, that is in sync with what Congress is going to be working on?
it doesn't conflict. It is in sync. It's in sync in that it at least establishes the landscape for what is a security and what's not a security. And certain things will be commodities that are going to be regulated by our sister agency, the CFTC. So what we're really doing is providing clarity on the line between the SEC and the CFTC and other regulators, because I think up to this point there's been a lot of confusion as to who has the regulatory jurisdiction over the many different things that you see in the market.
Well, part of that confusion is because Congress has failed to act, and some of that not completely its fault, though most of it. I am curious, would you have put this out had they actually moved forward with the Clarity Act last year and passed it as they had intended to do?
We could have put it out before or after. I think that we put it out now because we realize, time is of the essence. The markets are waiting, and they're waiting for this guidance. They're waiting for clarity. So this is really not going to conflict with anything. It's setting the stage, if you will, for the Clarity Act and the legislation to come.
I do also want to ask you about this safe harbor provision, the idea that a lot of these crypto companies would not have to register with the SEC. Is that blanket, or is there some sort of nuance in there that I'm missing?
No. If it's a security, if it is a security, the instrument, then they would have to register or have an exemption. And so the proposing release to come would set up a framework, much like you do for private offering of securities in Reg D. This would be something akin to a Reg Crypto, where you could look at the instrument and say, okay, this is a security, and we don't want to offer it and sell it privately, but rather we would rather have the protections of a federal securities regulatory scheme. So this will be something that most people would opt into and will comply with these rules, assuming once they're proposed and then later after we get comment and adopt them.
I do want to ask you another issue going on at the SEC. Some reporting earlier this week about the potential of doing away with the quarterly reporting requirements for publicly traded companies, potentially moving to a semi-annual basis. Can you provide any sort of insight into just how far along you are potentially in following through with this proposal that Trump floated a few months back?
Sure. This is nothing new. These were concepts that were floated 10 and 20 years ago, and they are back on the radar because the president has put out, an announcement saying we should look at it, and so we are looking at it. We are actively working on a proposing release that would go down the path of what could, semi-annual reporting look like. We'll ask a lot of questions. We'll get a lot of feedback, and then if it makes sense, if there's a consensus, we'll proceed, forward on that basis. But I think that it's safe to say that it will be sometime this year. It will be proposing, and if I was a betting man, I think I would say, it's probably not going to be mandatory. It might be something that's voluntary, and so companies could decide whether this is a good fit or not for them.
Yeah, but if you make it voluntary, though, does that create inconsistencies for investors where you have some companies on a semi-annual schedule and others on a quarterly?
Well, I would say there are always going to be very large companies that have the financial resources to report 3 Qs and a K. They're not going to change that. They're not going to go back to something that's just 1 quarterly report and a K. This is really, I think, designed to entice smaller companies. They might be in the life sciences field. They might be in a smaller banking regulatory field where the business, you don't need an MD&A, management's discussion and analysis, every quarter. You'd rather have management spend their time and resources on running the business, as opposed to once they go public, they're immediately doing Qs, and as soon as 1 Q is filed, they start work on the next one. So there will be some differences, but we have those differences today with foreign private issuers and domestic issuers. So I don't think it's going to create any problems.
All right. Jim, thanks for taking the time. Jim Moloney there, Director of the Division of Corporation Finance over at the SEC. When we come back, a conversation with Sheila Bair, the former FDIC Chair and current Senior Fellow at the Center for Financial Stability. This is Bloomberg. Just want to bring attention to our viewers that the post-settlement trading right now in WTI and Brent crude futures elevated. $100 a barrel on WTI crude here in New York, $111 over there overseas. Your 2-year yield now up 11 basis points from where it was yesterday, and that was the backdrop for the Fed meeting that we had today. Rates unchanged, and the Fed well, a little uncertain here about where economic projections go. But our next guest says that the lesson of the 1970s is that the Fed shouldn't actually respond to supply-driven energy shocks with accommodative monetary policy. Sheila Bair joins us right now, former FDIC chair and now a senior fellow at the Center for Financial Stability. So, Sheila, I mean, what does the Fed do? Is it just sort of sit on your hands and just wait for the economic ripples, if at all, when they do show up?
Yeah, I think there's so much uncertainty. They're wise just to stand pat. They really don't know which direction this could go. The inflation was high even before this energy shock. It was above their preferred measure was well above 2%, it's a little over 3%. So inflation is still a problem. And the thing about inflation is it hurts everybody. Borrowing costs, you lower rates, that helps borrowers, it hurts savers. But inflation hurts everybody. So in my view, if there's uncertainty, you kind of lean towards being a little more hawkish, not a little more dovish, especially in a situation like this. And, we don't know what this war could bring, what kind of economic disruptions, how it might spread. And I think they want to keep the powder dry, too. I think they were wise just to stand pat and see what happens.
And there was actually, we saw some real-time data coming out of the Chicago Fed and others kind of showing that monetary policy, at least for right now, is not restrictive, at least in their view. And it gets to the idea, too, and particularly drawing on your experience in the banking sector, this idea that we haven't, at least right now, seen any material slowdown in loan growth. We've had, some pockets of stress when it comes to delinquencies, et cetera, but nothing that's coming even close to what we saw in previous down cycles. Is that your view as well?
Yeah, that's right. I mean, if anything, I think we have a little too much credit. Look what's been going on in the private credit with the private credit funds. Some of the loans they've been making, I think it's certainly not restrictive, maybe a little loose. So there's no, if there was evidence of that would change the equation, but there's not. If anything, it's a little loose in my view at this point.
Do you feel comfortable, though, right now when we talk about regulatory oversight, given, and I don't mean just the oil shock that we're going through right now, but obviously what's been going on with private credit, obviously the potential impact of tariffs, this idea that we do have a financial regulatory system in place that can respond effectively if we do get to a more critical precipice?
Yeah. Well, I think so. There has been some fairly significant deregulation going on with the new administration, a significant weakening of a key capital requirement called the leverage ratio. Today, they were proposing more rules on what's called risk-based capital standards, and we'll see where that goes. That might be weakened as well. So it does concern me, and not that the post-crisis rules were perfect. They're not. They were too complicated. They reached too far, the smaller banks, some of the entities that really had nothing to do with the crisis. But overall, they were needed, especially with the largest systemic financial institutions. And to weaken them is really ill-advised. So I do hope that while they're looking at all this list of deregulatory measures that they want to move forward with, they're also looking at things like what's going on in Iran, those uncertainties, private credit exposures that could come back and impose some significant losses on banks, and they need to have enough capital to absorb them.
I'm also curious, too. I mean, we were speaking just a little bit earlier in the program with the SEC Director of Corporation Finance about this potential proposal, whether it comes true or not, of loosening the quarterly reporting requirements, potentially going to a semi-annual system. And it's kind of a head scratcher. I understand why companies want it, but given all the talk right now about what's going on in private credit and the lack of transparency there, and the idea that for public companies, we might create a system where at least they wouldn't have to be as transparent, at least with the same frequency. Is there a potential risk there, or are you comfortable maybe allowing companies to say, yeah, maybe a semi-annual system is better for us?
Yeah, I actually don't think that's a big deal one way or the other. They do semi-annual in Europe. I've been on several boards, served on audit committees. Quarterly reporting is very resource and time intensive, and it's helpful to investors. I don't begrudge it. But, I can understand why some companies would want to go semi-annual, and I don't think that would be particularly harmful if they do. Investors still may want it, even if the SEC allows it. I think, broader picture, what Paul Atkins is trying to do is make it easier to become public, because there's been such a decline in publicly traded companies. I don't think this is going to help much, but I think I'm sympathetic to his objective. But if he really wants to make it more attractive for companies to go public, I think he needs to make it less attractive for companies to stay private. Accredited investors now, which can invest in non-public companies, they're like 40 million people. The standards are not high. They haven't been adjusted for decades. And so that, if you're looking at public-private, you can access all of this money without being public, then your incentives to go public are reduced. So I think that's part of the solution here. That would be much harder. But again, I do applaud the fact that he's trying to make it easier to be public, because we do need more of these companies entering the public space. Even with semi-annual disclosure, they still have a lot better transparency and regulatory oversight.
All right, Sheila, I have to leave it there. Always appreciate your insights. Sheila Bair, former FDIC chair and now a senior fellow at the Center for Financial Stability. As we wrap up this Fed day here, let's push ahead to the next 24 hours and what their markets will have their eyes on. And I actually want to go straight to the central banks here, because we got a big decision from the Fed today, a Fed that to a certain extent is frozen. But investors overseas, they think they're going to see some movement, particularly with the ECB, where they're now pricing in 2/4 point rate hikes for 2026. We get a decision from the ECB overnight, from the BOE and the BOJ as well. So something to keep an eye on. We're also going to get some economic data here in the U.S., including those weekly jobless claims, as well as the leading index numbers here. So maybe potentially a little bit of a glimpse here into what's going on in the economy. And we get some earnings. Alibaba, Accenture, and Darden in the morning. But after the bell, we're going to hear from FedEx. And this is going to be key here, because the freight market has been under strain because of that elevation in energy prices. We'll have full coverage of that tomorrow, right here on The Close, right here on Bloomberg.